Good afternoon, and thank you for joining us for today's webinar as we take a look back at 2021 and look at the good and bad that's coming in 2022. Just a couple of reminders, as usual, we are in presentation mode, which hopefully means you can hear me, but I can't hear you, so please submit any questions and I'll take those at the end of today's webinar. Secondly, we will send out an email with a copy of the slide deck today, as well as a link to the recording of the webinar as well. Again, my name is Sean O'Brien, the president of QuickRate. I also serve on the board of directors of the National Bank of St. Anne. So, again, we come at this not only as providers to the industry, but actually consumers and users of products such as QuickRate and Quick Analytics and in Telecredit. Normally, I would be joined on the webinar by David Ruffin. David, unfortunately, is speaking at an Illinois Bankers conference today, so he is not with us. But he did prepare a presentation, which I will do my best to give, while not probably as well as he will. Most of you know David's background, but again, we started in Telecredit. David joined us in 2019 to build out a suite of tools that we call Portfolio Analyzer and Smart Loan Review. In addition, we do third-party loan reviews. And, again, I think it's important to always note that while obviously this is a new division in QuickRate, it does not come without tremendous experience. As you can see, David has worked on or led or overseen over 3,500 loan reviews in his career. So again, while we may be coming into the game with technology, we are certainly not short on experience with David and the team we have here at Telecredit. Just a reminder, again, we are doing a number of things beyond QuickRate. Obviously, we've developed Quick Analytics, which many of you are familiar with, and then, as I mentioned, David and his team, have in Telecredit. We're available for external loan reviews as well as developing what we think are really helpful analytical solutions for both internal loan review and just portfolio analysis. All right. What we're going to talk about today, just some economic policy choices, again, by the Fed. Inflation or deflation, really, it's at the heart of what's going on here. We'll talk about the QCBI results. And again, the QCBI is just an acronym for Quick Analytics Community Bank Index. We'll do a 2022 update from David on credit. We'll tell you what's the latest, what we're working on at QA and in Telecredit. And then we'll certainly take any questions. So I'm sure you're all tired of seeing this slide, but every quarter I think, all right, should I keep it? Should I get rid of it? And I feel like we should be getting rid of it. And we should have already gotten rid of it, but unfortunately, as most of the country just got through Omicron, hopefully, we're approaching an area where, we are getting back to closer to normal. And, while there's certainly the possibility exists for another strain to develop, hopefully each time we are getting, hopefully a smaller impact on it as more people get vaccinated. But unfortunately, probably as a whole, we're still not vaccinated enough. So I think this is clearly still impacting our economy. And so I decided I'm going to keep it in here until I feel like we can get through a year without any more strains, and hopefully we can put this to rest. I think deflation or inflation, I think this is really at the heart of what the Fed policy has been during the pandemic, right? It feels like a long time ago when the pandemic started and a lot of the country went down on lockdown, and everything just kind of grinded to a halt. Including oil prices, right? They dropped dramatically at the start of the pandemic. And the Fed was clearly worried about job losses and deflation, right? And so they took extraordinary measures along with the fiscal support to ensure that we and they did everything they could to keep the economy going and workers working. That has contributed to a significant rise in inflation, which I think they've admitted now clearly caught them by surprise. The strength and not only the persistence of it. Again, transitory is a word they used a lot last year, which looks like they have put to bed. But they do still continue to believe that this inflation will subside a bit. I don't think they're expecting it to go back to 2% that their target is, but that certainly by the second half of the year, we'll see this. It'll start to subside a bit. And that's their dilemma for this year, right? Do they act aggressively to raise the interest rates to fight inflation, which to kind of maintain their integrity and credibility on fighting inflation, or do they go slow and then they risk the chance that this inflation continues to persist? So it's a tough choice for the Fed because, again, they only have very blunt instruments which they can at their disposal. And so, again, I think they had taken the approach of trying to be a bit more deliberate. But it's certainly, it's played out the risks that they continually face. And, as it relates to interest rates, do we actually care whether they, act aggressively or not? And, I think the answer is probably yes, right? Because if they act fast and they really raise interest rates quickly and immediately and aggressively, right, they certainly had prior to the last couple of months risked the curve inverting, meaning short-term interest rates are higher than the long-term interest rate, which usually predicts recession. Now, again, since really November, we've really seen an uptick in the curve period as they kind of anticipate the Fed raising rates. So maybe this is maybe the curve won't invert, but it'll probably flatten. And the other alternative is if it does steepen on the long end, right, and then the market believes that the Fed's really in trouble and they can't get their arms around inflation, and inflation's going to be, a much longer term problem for us. So, again, I think their bet is they're going to move gradually, probably starting with, at the March meeting, raising rates and continuing to do it throughout the year, and with the hope that the economy will be able to absorb those and not push the economy into recession, and that in the second half of the year, we'll start to see inflation roll over a bit. And while it still remain probably stubbornly high, it won't be the numbers we're seeing, here in December, January, and likely of the first half of the year. So we'll see. Certainly, there's been a number of banks and investment banks predicting how many interest rate hikes it's likely to see this year. Again, going all the way to the high of 7 with Bank of America. If you're asking me, I'm sure the Fed hopes it's going to be less than 4, but it kind of exposes how hard it is to forecast. Is that all of these investment banks have armies of people looking at this, and you can see there's not a consensus on what's going to happen. So the Fed really does have a difficult job trying to aim this and guide this economy. But nevertheless, that's their job. So we'll see what happens. But again, it does demonstrate the difficulty of forecasting just overall, let alone for community banks, right? Just for anybody in general. So what do we expect, right? I mean, I think we'll see the Fed lower the balance sheet. They'll raise the Fed funds rate. We'll probably see unemployment go to potentially record historic lows. I think government support will lessen as the year goes on, all with the hope of trying to contain inflation without putting the economy into recession. That's really what the Fed's trying to do this year. For us, as we think about 2022, again, I think we'll see really good economic growth. Again, inflation is now the primary focus, and we'll see what that does to consumer confidence and sentiment. For us at the banks, right, and across the country, the ability to attract talent has probably never been more difficult. So that will be a challenge. In addition to retaining talent, will probably cost us all more. So those will be pressures on us at the bank. Cybersecurity, will continue to be a huge issue. It's kind of highlighted or accentuated right now with all the talk of Russia and Ukraine. That that part of this, if they do move into Ukraine, that they would probably coordinate that with multiple cyber attacks, not only on the Ukraine but also worldwide. So again, our radars will have to be up around that. Interest rates, again, they're going higher. How much higher will really be seen throughout the year, and then what does that do to our loan demand? Again, the bet is hopefully the economy is strong enough to absorb a lot of those rise in interest rates, but let's face it, none of our borrowers like to see paying any more in costs. All right, the affordability of housing, already high, and then you throw higher interest rates on, right? That could really, again, have an impact on our loan demand at the banks. In addition, that there's still just again a lot of uncertainty in the economy. So we're just not only are individuals a little bit reluctant maybe to borrow, but even businesses to a certain extent. So it'll be a challenging year to see what happens with our loan demand. Certainly non-interest expense, runs the risk and likelihood of going up. And so we'll have to continue to look for efficiencies at the bank, right? And that's why I think this year really has, you can look at it two different ways, right? The economy's strong, a lot of our borrowers are in great shape, but then there's still these other nagging things that, are hard to sense. And I think part of what you see is that, a lot of this can be geographical that, if you're in a larger metropolitan area, you might see a much stronger economy. And if you're outside those in a more rural economy, these challenges really might be more pronounced. And, again, I think that's not necessarily a new story, but it might be exacerbated in a year like this one. Excuse me. Again, because as you think about, households themselves, I think with the stock market strength and all the support that was thrown into the economy and government payments, I think a lot of our borrowers have more disposable income than they've had. But the frontline workers, are really still challenged and struggling, and the unemployment gaps, have probably gotten worse, and that has coincided with just the disparities in the financial health of people in our country. And again, so depending on where your bank is located, these things may or may not be as present or relevant, but in some cases they may be, very present and relevant. And so, again, I think it's hard to really get a grasp on what 2022 is going to look like for a lot of us at the bank. Again, I'm a director in a small community bank in Illinois. I think we'll have we're kind of through the budgeting process and talking about, strategic plans and things. And, again, I think we think this will be a good year, probably not as good as or as strong as last. But we're cognizant of the things that could potentially derail us, and are trying to take steps to address those, in the first half of the year. Just a note on where the workers went. I think this is a question that, I think a lot of people are still wondering because, we're at record unemployment, but still there's still a lot of job openings. And so I think that kind of dichotomy or just kind of poses the question, where did all these people go? And so I think, the working population has gotten older. Certainly a lot of them left for early retirement. We slowed immigration in our country, and so that, has really limited the number of new workers. Just the, coronavirus or COVID in and of itself has, made people stay home if they had gotten government payments, that maybe they've been slower to come back to work, be it for, healthcare reasons or childcare reasons. There's certainly been, in some cases, less incentive to work because of those transfer payments. And then even some of the mandates where people left jobs because they simply don't want to comply. But if you start to look at all these different numbers, it explains why we have this gap. As with any problem, there's never really just one answer or solution. It's always a myriad of things. But I think as it relates to workers, this really kind of explains where a lot of the challenges come. And it also exposes or explains why it's hard to come up with a solution to fix it, because there's multiple things that you're trying to address. No one thing is going to bring back, the 5 or 6 or even the 10 million job openings. None of those. There's no policy you're going to make to get people to take those jobs. And so this is probably a pressure that we're going to continue to see in the economy. Some things we asked last quarter, which are probably still worth considering at the bank, in terms of earnings, are we at a short-term peak? I think for a lot of community banks, the answer may be yes. I think for some of the larger banks, or more efficient banks, or banks that do all types of lending, then they're probably not. Reserves, again, we've talked to a number of banks with, in planning for CECL, who maybe, had raised or added to reserves during the pandemic and have been slowly releasing those. So again, I think it's a likelihood we'll probably see some, steady to releasing of reserves for a lot of banks this year. Loan demand, I think we're all asking the question, will it be the same or better or worse this year? And as we discussed, depending on your geography and your location and just maybe your loan mix, will probably speak to whether that's the same, better, or worse. The NIM compression is going to continue to be strong, right? We've got a lot of challenges in terms of rising interest rates, which in some cases again will be good for our hopefully our securities portfolio, but again potentially could be increasing our cost of funds. Mortgage activities, right? Refi activity as rates will rise will clearly become a smaller percentage of that activity this year. And so again, will you have new sales in your market? Do you have the supply of housing to drive that as well? So, like I said, there's positives and negatives, but there's still, while it still feels like it should be a very good year, there's challenges certainly exist. And then finally, most of us, and as we've all been kind of sitting on excess cash, wondering over the last year and a half, are these deposits going to be sticky? Now we're at the point where we may start feeling good about those deposits. How do we deploy them, right? How long, where on the curve, if we don't have that loan demand, which again can help mitigate some of the effects of the rising rates. But again, I think a lot of us, certainly saw tremendous deposit growth over the last couple of years. And, and again, I think a lot of it's been sitting in cash. And I think this is the year where we all probably start to deploy that a little bit more effectively and strategically. So again, as you look out, there's a lot of positives, but still some negatives remain. So let's look back at last year. We fell under 5,000 banks last year. We continue to drop. So now we're just shy of 4,900 as we start 2022. Again, the breakdown, 2/3 of the banks in the country are under 500 million, but now they, only hold 20% of the aggregate assets. So again, it's again for community banks, it's still a wonderful time, but it does speak. It's it's harder and harder for us to fight for our market share in our locales. As I mentioned, we saw good asset growth, so nearly 10% over the last year. Half the banks in the country saw asset growth over 50 or over 10%, excuse me. But as you can see in the bottom chart, the larger banks certainly had more success in growing assets than the smaller ones. Everybody still did well, but certainly they got a larger share across the board. Loan growth, this was at least in some ways a bit positive. We ended the year with slight loan growth. You can see in the top right chart, there's still 41% of the banks in the country, though, that experienced no loan growth, right? And so that was the problem last year. I think it's going to continue to remain a problem strategically for a lot of banks is where do you find loan growth? And then you add to the fact that rates will be rising. Again, it just poses some real problems for banks, if you don't have a good supply of loan demand, which will again continue to put pressure on our NIMs. You can see in the bottom chart, all the rest of the asset buckets other than 0 to 100 million were positive, but if you were 0 to 100 million, you actually saw contraction at the median for loan growth. So, again, while it's all banks of all sizes can continue to be successful, it does present some of the challenges, the under $100 million or banks are facing, as we move forward. As I mentioned, we're all sitting on a lot of cash because deposit growth has remained really strong, nearly 12%. 61% of the banks saw greater than 10%, but really everybody across the board experienced it. So again, it's good in some ways. We've got cash to deploy. The rising rates, again, may slow loan demand, does allow us to act and put that money to work along the curve where you see most, strategically based on your book of business. Yields on loans rolled over, not surprisingly. So, it's been rolling over the last couple of years. Cost of funds, is, outstanding at 32 bips at the median. Net interest margin, you can see from 2019, right? We've lost nearly 48 basis points at the median. Non-interest income, not surprisingly, ticked up last year, with all the mortgage activity. And again, because of a lot of that we still continue to see efficiencies, in the efficiency ratio, or improvements in the efficiency ratio, excuse me, which again is a credit to all of you as you continue to do good work in the face of, again, really good times in some ways, but nevertheless still very challenging and difficult times. Profitability, as I mentioned, right, remains outstanding, right? If you look back over the last 5-6 years, for the median, ROA number, it's better than we've been. It's really just, again, a tribute to all of you in the audience, how well you've done managing all this, and that's correlated into really strong core operating earnings, and then, again, very strong ROA and ROE numbers. So that's why I said sometimes it's difficult to really get a sense of where we are, because 2021 turned out to be such an outstanding year in light of the pandemic. And then you kind of look ahead to 2022 and you think, okay, it still feels pretty good. The economy is still really strong. More people will go back to work. We should still be reopening, but then we'll have this drag of, potentially higher interest rates, and then also maybe a lack of loan demand. So again, there's good and bad, and so we'll have to work hard again to produce the numbers from last year. But again, I think the important thing is there's a lot of people working. The economy is still strong, so hopefully we'll be able to now navigate the rise in interest rates that we will most assuredly see this year. All right. Excuse me. So we'll look at some, credit metrics. I can say from reading a lot of year-end surveys by bankers, this is not a concern at most banks, or virtually any bank. With all the largesse and the PPP loans, not only did it bring, a lot of activity to the banks, but, it really made loan quality just really a non-event. Again, going into the pandemic, there was certainly the sense that we would see credit hiccups, but because of the fiscal support and stimulus, however you want to characterize it, we really just haven't seen that at all. And that's really borne out in the three numbers that are ratios that David always kind of touches on, with the NPL to loans, charge-offs to loans, and the ALLL to loans, right? You can see, big sharp moves in in non-performers. Charge-offs are virtually non-existent, and the reserves in many cases still ticked up this year, which leads to the inverse of this, which is, the coverage to our non-performers. And you can see a very strong uptick in every region across the board in 2021. So, right, I mean, it's in terms of asset quality, we're I don't want to say the best of times, but they're pretty darn good. And so credit concerns and credit quality just really weren't on the radar in 2021, as most of us experienced, near perfect years in terms of asset quality. And so again, puts another feather in the cap of feeling really good as we start 2022. No meaningful, regulatory concentrations. You can see at the bottom of these charts, right, just the number of banks who are above the guidance. But even just nationally, right, in terms of construction and development, only 212 banks in the entire country are above 100% risk-based. And then in terms of CRE, there's only 270 above 300%, right? So concentrations just really, for the most part, are not even an issue right now for most banks. That's, bears true through multifamily, C&I, and even ag, right? Just no concentrations that are of concern or that were increasing as we went through 2021. So again, from a credit quality and just asset quality perspective, things feel really, really fantastic, which, probably is a reason why we should start caring. All right, so just loan growth trends, as David touched on before, there was negative momentum leading into the pandemic at a number of these quarterly sessions last year, exacerbated by the PPP runoff. We had a couple of quarters where we were seeing negative loan growth. Again, the 41% of the banks did experience negative loan growth, but this is the challenge for a lot of us in our world, right? Is that there's just, do we have enough loan demand, for us to generate the returns that we want, need, and our shareholders are expecting. And so, the flip of all this, right, again, is we're later in the cycle, which may have been kind of extended through the fiscal support, but there's where do we find it? And then you have the continuing competition from the fintechs. Is like where's our loan demand coming from in our markets? And that's really what this kind of talks about is, right, we're competing against non-banks more heavily than we ever have, and you can see their percentage of and growth of corporate activity, lending, and bank C&I lending, right, where they've converged, and it just kind of highlights or speaks to the problem that all these non-bank lenders who are not regulated, really are encroaching upon our business, and there's really no signs to say that competition is going to be any less going forward, and in many cases they're just very well heeled and very have very deep pockets, and really are driven by technology, which makes it difficult because we as a community bank, it's just difficult to maintain the level of investment necessary to address a lot of these fintech companies. So loan growth is on my mind. I'm sure it's on a lot of your minds. The impetus for growth, is certainly the Armageddon and credit quality from COVID did materialize. So we feel good about where, again, as we touched on, where borrowers' balance sheets are. People are working and have jobs. So it feels like, again, it should be a really good environment for loan growth. The mid to late 21 trough in loan growth has abated somewhat. The investment bankers certainly are looking and, for the profitability that comes from banks, with strong pipelines and, diverse mix of loan sources, which clearly will improve valuations for banks. As we touched on, the shadow banking environment, the fintechs, we're under attack from not only our competitors, but a lot of these non-bank lenders as well. And then again, we've had this huge churn in the economy. So, our borrower is changing. They're being approached by multiple providers and new providers of loans, particularly in the mortgage space or, auto space. But now the buy now, pay laters are going to, come into focus. And we'll probably see, and we've already seen, right, even more people enter the SBA arena who are non-banks as well. But we do have a capital cushion that's larger than we had during the last banking crisis. So, right, the sign's open, right? Where banks have money and are willing to lend. We just got to find ways to make sure we can find those borrowers and make sure we have the loan products that they need. And so, so that leads you to potentially looking at some different ways or different, sources of loans that maybe you've looked at in the past or, did in the past, but you might have to reconsider. But it's really a different mindset from where we came out of the last crisis, where, again, in the last financial crisis, there was really a push to have banks diversify their loan sources or their loan books. There's a push to, really kind of look inward and maybe not get into, new areas of lending, despite the fact that they wanted you to be diversified. So it really kind of created some conflicting messages about the loan book. But I think now, for a lot of us, we may have to kind of dust off and revisit, some things that, in the past maybe we wouldn't have considered, just because in some ways, you need to be able to say yes to your borrowers. And again, depending on the geography that you're in, there's only a certain handful of types of loans that you might be able to do. So, again, I think this is nothing new or earth-shattering, but I think it's a reminder to, kind of embrace, looking at SBA or FHA or other government-guaranteed lending programs, because as we touched on, while, the large percentage of borrowers, the A borrowers or the prime borrowers, are really in strong positions, there's a number of people who are still battered and bruised from COVID and the pandemic, and they may only qualify through some type of government guaranteed program. I think that's certainly true in the small business arena, right? That we've seen industries ravaged by the pandemic, and many of them losing their businesses. And if they try to re-enter the space, they probably will not qualify conventionally, right? And it'll take an SBA program. And so, again, these programs require expertise that you may not have at the bank. And so that's why you have to look to, partners. And in the past, we've done webinars with Arnie Monson at Holtmeyer and Monson. But I think it's finding, good, credible partners that you can work with who can assist you in being able to say yes to not only these new types of loans, maybe for your bank, but then also helping you, be able to deliver those, effectively. I think this is some ideas are not always new ideas, right? I think this is something, again, coming out of the crisis last time, a lot of us moved away from doing any types of participations, but I think, depending if you have good culture, compatibility with other banks or partners, exploring participations is probably worthwhile. Again, what you see in many markets is a feast and famine in terms of loan activity. Some banks have continued to see really robust and strong loan demand, and they can't keep it all. And then others are, really just have the capital, but no loans. And so I think, exploring partners and I think the real issue here from, our number of years of being approached by people who wanted to, do participations or offer participations even through the quick rate marketplace. Loan culture is everything, right? Everybody's interested in participations until we get the actual underwriting to the bank or the board, and then it's the tough question is, are we comfortable with this bank's underwriting practice, with our own culture, and again, that's not something I can answer for you, but I think you should go into this if you are going to explore that. Really focus on banks that you either know and trust or have worked with in the past, but the culture compatibility in terms of credit culture really is at the heart of whether this will make sense for you. But again, can be an effective way to add some loan growth if you're not able to locate it. I think, again, giving up on the all things to all people, finding niches that you're good at, I think that's really kind of the lesson. Again, coming out of the last crisis, they wanted us to be able to do a lot of different types of lending. And then I think what we've seen here over the past few years is, right, we all have our core competencies and expertises. That's where we really need to drive home, right, if you can. And so, building out those practices if you can, expanding those footprints, again, working participations in those areas, those are all might be a ways to drive some loan growth in 2022. This is something that David's touched on in the last couple of webinars, is looking for maybe niches in lending that aren't going to be disrupted by an e-commerce or potentially rooted in alternative lifestyles, right? We've talked about cannabis banking before on these, just banking cannabis, but then potentially lending to it in the future. Other service industries that maybe in the past you wouldn't have considered, but a lot of those service industries are really strong businesses now. And as David pointed out, and was brought to his attention by a customer of ours, Kevin Fahrenkopf at Bank of Hemet, that aren't going to be disrupted by e-commerce, right? Amazon is not going to disrupt them. A fintech is not going to disrupt them. Looking for those types of opportunities, again, maybe it's something we didn't do in the past, but might make some sense as we move forward. Reluctance to feed deficiencies in the local supply and demand. Again, a lot of banks got out of construction and, development lending. Again, I think those are things that you may have to reconsider as you move forward. So, all of those things require, expertise and competence, and so they don't happen overnight, and you don't want to rush into them. And so, I think it's a good reminder to not consider those new initiatives unless you're going to be able to, retain your lending talent ensure the efficacy of your risk protocols, and where you can embrace technology, because that will, enable you to not only probably attract a larger potential group of customers, but also making that work profitable by processing it, as efficiently as you can. So nothing's easy, but as we enter 2022, just some things that all of us might have to start to look at. All right, so in some ways I feel like maybe I'm talking out of both sides of my mouth, right? Because you have to investigate and evaluate loan growth, but at the same time, right, we have to meet that with vigilance, right? So we have to recognize the pristine credit quality brought on by a lot of the government largesse will end. Inflation is certainly real, and so the rising rates will have credit impacts, right? And so we have to be aware of them. They won't happen or occur overnight, but it does feel like we'll be in a different paradigm. We learned from the last crisis, loan growth in the later stages of the credit cycles, are always the most problematic. So we have to be measured and tempered in even these, as we're looking for loan growth, making sure we're being diligent. And it's been such a long time that any of us have experienced any uptick in credit stress. Just even our cultures within our boards, right? I mean, a lot of us have had such pristine asset quality. Any uptick in it might, just send, shockwaves that they want to, slow lending, right? So again, I think these are the real world concerns and practical considerations we have to, kind of, self-evaluate ourselves, or, kind of self-test in our banks, because, again, we want to go out and find new loan growth, but we do want to be measured, tempered, and diligent about it. So I think that's where, again, having better, really strong credit management process and tools helps. Improved analytics, better loan reviews, and certainly stress testing, are things that will probably start to come back on the radar, over the next 12 to 36 months. And as David likes to say, right, write your own credit risk script, right, before a regulator does it for you. So in any of these areas where you might start to, move into a new area of lending, really be prescriptive about how you're going to handle it. It's probably not a bad time to just review all of your policies, just to make sure they're in sync with what we're doing today at the bank. The policy limits are right, the practices are appropriate, because again, the easiest thing to do when we're looking for demand, and what the regulators are always worried about, is are we lessening our underwriting standards? So it's probably a good time just to check, where are we, what do we want, what are we willing to accept, and then again, go out and attack our markets like we always do. Okay, so that kind of gets us through the presentation. Just a couple of reminders, quick analytics. We're doing multiple things for you, so just a reminder to take a look. Certainly many of you have already subscribed with us for quick analytics, but certainly in the last year, because of the CECL solver, we've seen a very large rise in our customer base. So we thank you for that. But there's a lot more to quick analytics besides the CECL solver. So we encourage you to take a look at that. As I mentioned at the top, Telecredit is our newest offering. If you think about it, quick analytics, we're looking at everything on the portfolio level. Telecredit is really coming up from your loan level analysis, right? It's really designed, besides us, doing third-party loan reviews, it's about giving you access to information and being able to query your own information, on your desktop, much easier than, say, maybe, requesting a report from your core. So it's pretty easy to get you up and running. But again, I think we're really excited about this, particularly as we head forward, into a potentially a different credit environment. I think, the reminder here is always, we think we've most importantly built solutions that are easy to use and deploy. We don't want to make this, difficult for, to be, integrated into your bank culture. We want it to be easy for everybody to use and learn. So not only do we try to develop a new solution, but we developed it with in mind that anybody could use it with very little training, because hopefully you'll find that it's very intuitive to find what you need. And I think the other thing is we've made it affordable, right? There's a lot of great technologies out there, but a lot of them are expensive and are priced themselves out of what a community bank can afford. I think we've prided ourselves on our 35 years here at QuickRate of building tools that not only can you use, but I think all of you would agree, we haven't priced them beyond their value. I think everybody who buys from us has gotten good value with our services, over the years, and we think that's a good partnership, for a vendor and a bank to have. We're not finished talking this week. We have another CECL coffee talk at the end of this week, where we're taking questions. We'll have a couple of topics, and then we'll also have just a more in-depth CECL Solver demo on the 24th. So again, we are here to help you. We want CECL to become be a non-event for you as we transition from the incurred loss to CECL next year. So we can not only assist you with explaining how our tool works and how it can hopefully make your life very easily, but we also want to, in a sense, have a way with a user group to take questions every month of things that might be concerning you about picking a solution, or even as you're using our solution, things that might come up and you have questions on. So, it's our way of staying in touch with you and ensuring that we will serve, and deliver on what we need to do to get you to a safe transition. All right, so thank you all very much for attending. I'm going to check the questions here in a second. Just a reminder, if you want to get a tour of Quick Analytics or Telecredit, to reach out to us. If you would like a quote on your next loan review, we would love to give you that. And then I know the next couple of weekends we will be attending both the ABA and ICBA conventions. So I would encourage you to stop by and say hi to Ricky and Melissa, myself, David Ruffin. We will be at those shows, and we'd love to tell you more about what we're doing. And if nothing else, just catch up and say hello. And we'd love to have you stop by the booth. So let me check here if we have any questions. I'm not seeing any. So again, I appreciate everybody's time today. I hope you found the information helpful. We'll be back in the next quarter with another presentation. And again, in the interim, if we can help, just reach out to us at info@quickrate.com. And again, maybe hopefully we'll see you in the next couple of weeks at the ABA or ICBA national conventions. So thank you all again very much for your time. We appreciate it. I appreciate you coming in and working with us at QuickRate, Quick Analytics, and Telecredit. And we will speak to you soon. Bye now.